It's our mission to give IT pros a break. So, here it is. We wish it was longer, but to keep saving IT pros time and money, we only paid for a 30-second ad. From racks and PDUs to backup power, Eaton and Trip Light have joined forces to bring more sanity to your day every day. Visit eaton.com/audio today.
Cloudcast Media presents from the massive studios in Raleigh, North Carolina. This is the Cloudcast with Aaron Delp and Brian Gracely, bringing you the best of cloud computing from around the world.
Good morning, good evening, wherever you are, and welcome back to the Cloudcast. We're coming to you live from our massive Cloudcast studios here in Raleigh, North Carolina. And it is Aaron for Cloud News of the Week. And here in the United States, the New Year's behind us, the holidays are behind us, and we're starting to settle in. And we have a really good look-ahead show again this week. So looking forward to that after we get to the news. Let's jump into a few articles. We see things starting to pick up now. Number one, the CNCF got a new project, a sandbox status project. CNCF accepts CubeScape as its inaugural open source security scanner. And so this comes from the folks over at Armo. And it's really an interesting read of where they're going with a project like this. What they can be able to do with this project, it can handle misconfigurations inside manifest files like YAML. It can do Helm and basically throughout CI/CD pipelines and inside the clusters themselves. It also scans for CVEs in the container image registries, and could be Docker, it could be Quay, ECR, etc. So it'll be really good to see how this gets adopted and how it proceeds forward, and really helps folks in the DevOps and DevSecOps space going forward. With that, I'm going to move on to article number two. Article number two is from Azure, and we recently did our look-ahead show on AI trends, and we talked pretty heavily about OpenAI project and large language models and ChatGPT in particular. And while it's not necessarily something we're going to talk about all the time, I felt like this general availability of Azure OpenAI service was worth talking about because it surprised me slightly. I knew that they were working together, and they've always been working together, this ongoing partnership between OpenAI and Azure, but I didn't know the depth of it and how far back this has gone. You know, I admit, for me personally, when I think about AI-related services, I tend to think about Google and GCP, but Azure really has made a lot of progress there throughout the years, and it's a good read into what they're doing now as well as in the future, and a historical look. And they've been going back, 6-7 years almost to what they've been doing with AI in this space. So definitely take a look at that. And moving on to our last one, I found this one really interesting. This one was over on the AWS Marketplace blog. And it's the most viewed AWS Marketplace blog post of 2022. So this is the Marketplace blog. So this is, think about folks that are putting things in the marketplace. They're trying to make money off of this. They're trying to get into the AWS ecosystem. So this is from their standpoint. Top 10 tech tutorials, 5 of the 10 were all about multi-account management. And it was really interesting that so many of these are talking about security and identity management. I mean, it's an ongoing trend with AWS in general, I feel. And then, of course, there's the top tutorials for sellers and the top announcement blogs and the top verticals posts. It was interesting to see what is truly top of mind and where the marketplace producers are actually thinking. So with that, I'm going to close out Cloud News this week. Coming up right after the break, we have returning guest Aneel, and we're going to be talking about venture capital funding and a look ahead into 2023.
Datadog is a SaaS, cloud monitoring, and security platform that enables full-stack observability for modern infrastructure and applications at any scale, providing teams dashboarding, alerting, application performance monitoring, infrastructure monitoring, UX monitoring, security monitoring, and log management in one tightly integrated platform, plus 450 plus out-of-the-box integrations with technologies including cloud providers, databases, and web servers. Aggregate all your data into one platform for seamless correlation, enabling teams to troubleshoot and collaborate together in one place, preventing downtime and enhancing performance and reliability. Get started with a free 14-day trial by visiting datadog.com/cloudcast. That's datadog.com/cloudcast. And we're back. And folks, if nothing else, if you listen to the show for a little while, one of the mantras that we always talk about, if we're not talking about some sort of technology, it's follow the money. And this year is I think going to be a little different. Aaron, it's good to be kicking off another look ahead show. These have been great. They're always fun to kick off January, but this will be the first one we really sort of do the follow the money look ahead show.
Yep. And it's really, I would encourage everyone as well. It's in the show notes, but it's a follow up to last year's look ahead show on this. So you can almost think of this as part 2 in Follow the Money.
Yeah, absolutely. So, one of the things that we're very fortunate is to have a bunch of friends in the industry who not only are, inventing very, very cool technology, and in some cases, they're also, very involved with both the sort of future direction of what things are going, but also helping to enable that. And helping to enable that often means, being part of where the finances come from with things. And so really, really excited to have longtime friend of the show, longtime guest of the show, Twitter artist, coffee artist, if you will, and investor at Crane VC, our friend Aneel Lakhani. Aneel, welcome to the show.
Thank you for having me again.
Great to have you back on, man. So if folks have listened for a while, they are familiar with your voice. They are familiar with your Twitter feed. But if anybody's new to the show, or they're new this year, give us just a little bit of background. You don't have to go back too far, but what are you up to these days?
Sure. So I'm Aneel. I'm an investor. I do early stage venture capital at a firm called Crane out of London, although I myself am based in New York. I've been in tech for 27, 28 years now. Started my career in engineering and did a bunch of stuff between there and here.
Nice. And Aneel and I we've been colleagues. We were colleagues when you were dabbling in marketing. So you've seen all sides of this big beast that we live in.
That's right.
Yep. So Aneel, we covered a lot of VC basics in last year's show. A lot of like, what is a VC and how do you think about it and what's day to day. And so I didn't necessarily want to rehash a lot of those. But again, link in the show notes for those that missed it from last year. But we still get just a ton of questions around VC funding and VCs in general. And so kind of give everyone the elevator pitch version, if you will, for those new to the show. Like, what do you do day to day? And also, if you could, just go into a little bit about Crane for just a second of why is Crane different from some of the traditional, say, Sand Hill Road VCs?
Sure. I'll start with what I do day to day, because it's not honestly as interesting or as cool as people seem to think it is.
It's not mostly just a crystal ball.
It is not a crystal ball. Mostly I spend my day talking to just a lot of people all the time. So that means talking to people who want to raise money for a startup or have an idea, talking to people who want to invest in startups alongside Crane, or that we want investing alongside us, talking to people who can help me validate whether an idea is good, whether a product is good, whether a technical approach to something is good. And those can be practicing engineers, those can be customers of competing products, it could be anyone. And all day is just trying to figure out if the idea or the proposition or the startup or the founders that the firm is looking to invest in are going to be a good investment. And it's just getting more and more certainty on that. And you can't ever be absolutely certain, but you get as close as you can, and then you have to make a decision, because usually time forces you to make a decision, or competition forces you to make a decision. And that's just what you do all day, every day. And you're just operating in this mode of, well, I've got this much money. I can only spend it on so many things. I got to figure out the right people or the places to put the money so that it will turn into more money, so I get to keep doing my job.
Yeah, and I gotta imagine a lot of it is is you're not only doing that all day long, and as soon as you go to write a check, to close a deal, to whatever, your priorities may change. That next shiny thing comes along, and it's all of a sudden you're like, oh, what am I, like it's got to be sort of this yin and yang all the time of sort of, I don't want to say like buyer's remorse, but just like you can only make the decisions based on the data that you have, and the rest of us idiots who kind of see the headlines and stuff are like, oh, you should have seen this thing, or you should have known this was coming. It's got to be sort of an interesting kind of yin and yang each day of like, I have to be totally committed, but yet you're watching headlines just like the rest of us.
Yeah, and you never actually, you can't know everything. You never actually know. And it's not just the startup, right? It's not just the startup you're looking at. It's also, what is the likelihood that even if this startup is right, that the market they're in will exist in 5 years or 10 years and won't be destroyed or undercut by some advance in technology that we don't see, or that the macro conditions and interest rates won't change and make buyers flinch about spending money on a new risky product, or any number of other things that have nothing to do with just the company itself or just the founders themselves, that end up being factors in the decision that you cannot predict and will never be able to predict.
Yeah. I think, as Aaron and I were talking about this, and we were kind of doing various prep stuff for the questions and for the show, I think we kind of came back to this, like, the world has changed. I mean, it feels like, the world's obviously changed a lot in the last 3 years because of the pandemic, but just economically, the world's changed a lot in the last 6 months, because of interest rates, because of people's, inherent biases about what things mean. Like, how do you guys think about that? Like, this is really kind of the first time in 10 years or so when the market for investing wasn't, I don't want to say like it wasn't easy, but it didn't feel like there was like big headwinds. How do you guys go into it when things change? Like, how does your thought process change when things like this change?
That's such a good question. I can't answer for we, because I don't know, but I can answer for me. I definitely can't answer for venture capital as a whole, because there's no such thing. It's just right. A bunch of people, and they have very, very, very different styles, not just from firm to firm, but from individual investor to individual investor. Within the firm, you'll see people make decisions and behave in wildly different ways because they care more or less about different factors in the world. And so there is no, like, you end up with some consistent behavior over time that you can look backwards and go, oh yeah, this is what VC was doing in general last quarter. But in real life, day to day, that is not at all how it works. So for me specifically, there are two, maybe three kinds of things happening that are dramatically shifting sands underneath my feet. And I say this as someone who's new to doing this. I've only been doing this for a bit over a year now, full time. And these handful of things are the biggest one, of course, is the change in interest rates, which I don't know why people don't care more about, but they should really care more about in the world of startups. Like, we're starting to see its impact at the late stages. What is it? Sneak just did a $196.5 million round at a $7.5 billion valuation. The last one was a $530 million round, of which really only $300 million was primary capital, meaning meaning equity that the company sold, versus secondary, meaning existing equity holders selling their own shares. So let's call it $300 million. Was done at an $8.5 billion valuation. That, of course, is what we would call a down round. Their valuation went down. Same thing happened at Data IQ. I actually don't know how to say the name of that company. They did $200 million at a $2.7 billion valuation. The last round was $400 million at a $4.6 billion valuation. That would seem a much bigger fall. We're only beginning to see this, right? We're seeing estimates for revenue and earnings and valuations for public software companies come down a fair amount, like more than half of the, let's call it, top 10% of public software companies are seeing all those numbers come down, or all the estimates come down for 2023. We're starting to see it happen in late stage private companies that are not public yet, like Sneak. That this set of facts is just that how a software company is valued is being reconsidered in a higher interest rate environment and in a different economic environment that eventually pushes its way upstream through all of startups and the whole startup ecosystem. If money is more expensive to come by, then people, and you can get great returns on effectively investments that have no risk, like treasuries, right? Compared to startups that are all risk all the time, where the vast majority of them fail, right? Like 90+% of all startups fail.
Right.
These are the facts. Then people are going to be less inclined to put their money into startups, which means the bar for investing in a startup goes up, and the value and the bar for high valuations goes up. And that eventually that means that, I'm not going to want, as an early stage investor, to invest in something that's an incremental improvement, right? Like, I'm not going to want to invest in yet another minor improvement in how Kubernetes is deployed or operates, because there's more than 100 of them. I don't need to invest in the 101st. That's incremental. That's not like a game changer, right? So all these companies that are like incremental improvements on how something works that don't dramatically change how something works and don't give you like an obvious 5 or 10 or 25x reduce costs, increase revenue, leverage on your existing staff or something, become harder and harder to justify investing in. And if that's true, then those things become subject to ceasing to exist, right? And we've got lots. And I just picked on Kubernetes because I like to pick on Kubernetes, but there are lots of other spaces where that's true, where we've got 25, 50 plus startups that all do effectively indistinguished things from each other, that are incremental improvements in some domain. Those things are going to run out of oxygen. So, and all of this starts at the fact that there's an interest rate change and pushes back up through the whole ecosystem.
Yeah, Aaron, it almost sounds like Aneel listened to our KubeCon review when we talked about every sector had 12 companies in it.
Yeah, well, and yeah, you look at the famous or infamous CNCF landscape thing, right, which is like a NASCAR logo slide at so small, like you got to zoom in, like it's insane, and it makes perfect sense, right? What you're saying, and I liked you casually worded as subject to ceasing to exist. But I guess maybe too, like there's this trend, and sometimes we used to think at startups as a shorter term, right? Like A round, B round, C round, go for IPO, maybe take a D round. Now you've got like Sneak was what, like a G or H or J, or I don't know what the hell it was. It's like, but you see a lot of companies taking more and more money and going longer and longer rounds. And so there was almost this like short-term versus long-term view. And we kind of go back to like consumer investments and personal investments. And advisors always kind of say, hey, take a long view of everything, right? Because horizons, with a longer horizon, you have more, a longer term. But at the end of the day, if I'm getting this correctly, like VCs do tend to take round to round viewpoints, or do they take longer term, right? Like,
yeah, this is a somewhat complicated, and I'll try to do as good a job as I can in explaining this. So again, there's no such thing as like what the industry as a whole does, right? If you look at people who invest in later stage private companies, sometimes they'll have a short-term view, sometimes they'll have a long-term view. They can make a lot of money on a short-term view because they buy in a late stage, the company IPOs, they sell, they make a quick 50%, 100%, 500%, whatever, and it's everyone's very happy there. But sometimes those investors will hold for 10 years, 20 years, whatever. And the same is true all the way down the stack. The earlier stage an investor is, for instance, what we do at Crane, we are forced to have, to some degree, a long-term view, even though if the next round of a company I invest in is higher and it's a good price and a good valuation and it goes up by a big number, I'm happy, everyone's happy. The people who invest in Crane are happy and are more likely to continue investing in Crane. But we don't, those are like interim numbers, right? The numbers that we actually put up and get measured against are on the final numbers, like the actual cash we make when the companies that we invest in go public or are acquired and have exits, and that cash gets returned to our investors, and that cash should be a multiple of the money they gave us, or else we haven't done our jobs well. So the earlier you go as an investor, the longer your time horizon theoretically should be, although some people don't behave that way. But for me, any investment that I make, 5 years is the minimum in my head of the time horizon, and I'm expecting more like 10, because it's actually on average 10. There have been some periods in time when you've seen a lot of exits in sub 5 years. Those were aberrations. Generally speaking, at 7 to 10 years or more before an exit, which means you have to invest for the long term, which is also what makes my job incredibly challenging, because you don't know shit about what's going to happen next year, much rather 10 years from now.
Yeah. Well, quick follow-up on that, Aneel. So, because again, I've been involved with startups, Brian's been involved with startups, and yeah, we historically have thought about an exit means an IPO and or company is acquired. But in the VC world, there is almost like a third quote unquote exit, like you were talking about with Sneak, of like a late round buys out an early round. But I mean, it doesn't affect the employees, but it affects the VCs, correct?
That's right. Well, no, sometimes it affects employees. There's been a small trend of later stage startups giving employees liquidity, which basically means letting employees who've exercised their options and bought their shares sell those shares in future financing rounds up to a certain percentage. So whatever, like different companies have different policies about this. But generally speaking, you're right. It's not employees who get those chances. It's early investors who get those chances. And that is a means of exiting your investment before the company exits by virtue of having an IPO or being acquired. That's not a thing one counts on, because it's something that would happen on a case-by-case basis, and tends to only happen at huge dollar amounts and values, like what we talked about with Sneak, where they did do secondary in their previous round. It tends not to happen anywhere within the lifespan of an investment that I'm involved in.
Fair.
I'm curious. So you sort of talked about. You don't want to be involved with the 25th backup company, email company, Kubernetes company. There was a certain amount of that during, this last boom where, the market would sort of be evolving. It felt like there was a bunch. And then, sometimes there would be like, well, but the market hasn't really evolved. And this new team, may have a chance to sort of figure it out. I'm curious how you think your mind might shift if you're now thinking about 5x, 10x, 25x things that are better by those sort of multiples. Like, how do you shift your thinking? Because you're going to be seeing a lot of stuff that you're going to be like, I don't know that I can wrap my head around this yet.
It's so this is something I can talk about it for Crane as a firm, because we do have an explicit way of dealing with this or thinking about this at the firm level. I mean, I say firm, we're like 5 investors, so it's not really a big thing here. But it is that we kind of make ourselves constantly raise the bar on all dimensions of an investment. So you I'm not going to do an investment if it doesn't, in general, look better than my last investment. Every investment has to look better than my last investment on all dimensions. And that's just what we try to do, right? So we kind of force ourselves. You can't always hit that mark, but you force yourself to constantly raise the bar. So that's one way of dealing with it. But another way of dealing with it is that it's explicit. We are looking for things that can be game changers. Are we always going to be successful? Of course not. But like when I describe what I want to invest in to people, I say I want to invest in things that will become critical infrastructure for the next way of doing something, right? So for the next way of managing a particular supply chain, for the next way that developers build back-end applications, for the next way of whatever, right? So I'm looking for things that become almost foundational to how people do something or build something. And that's one way of taking this approach. Because those things often are hard to wrap your heads around, because sometimes it's like, oh, this is how people who are just starting to build software, who are teenagers, will be doing things 10 plus years from now when they're professionals. You have no idea. No one has any idea. But it's sufficiently like interesting that you try to wrap your head around it, and sometimes you're right, and most of the time you're not.
Does analysis paralysis ever kind of kick in then? I imagine this is like, what you're explaining to me, it seems like a certain personality type has to do this job, right?
I actually don't know the answer to that, because, well, the thing about certain personality types, because VC is full of all kinds of, there are VCs who invest purely on the basis of whether or not they like somebody, right? They're like, sure, my gut is so good that I can look at a founder. I can spend an hour or 2 hours or 10 hours with a founder, and I don't care what they're doing. I don't care about them. I don't care about anything. I'm just going to invest in that human being. And then there are people like me who are like overly analytical and are like, no, I care about the market and the product and also the founders and also the macro dynamics that impact that space that we know about or don't know about. But I also care about like the 10 other things that budget holder has on their mind, the customer, that are their priorities. And maybe I also care about, well, this is a good way to solve this problem, but is there an okay way to solve that problem that costs half as much that already exists? And I am the analysis paralysis guy, right? So there is that possibility, but fortunately, time forces your hand, right? Either the company needs to raise money, and if I don't give them money, someone else will, or there's some combination of time and competition will always force my hand, so I can't do the analysis forever.
Fair. Yeah. You mentioned that we're seeing obviously tightening of money flowing into new deals, so people are trying to refinance. That's or do new rounds. That's trickier. But you also mentioned that like public companies, companies who may be acquirers of some of these startups may be having, tougher 2023s than they did in the past. Do you guys feel like they still have big enough cash reserves and may look at some of these companies that are, potentially taking a down round, and they look at it and they go, oh, okay, maybe prices of acquisitions are a little more reasonable? Or do you think they're going to look at their own business and go like, I better keep more dry? Like, do you get a sense like they're going to keep more dry powder for when things get better? I don't know. Do you get any sense of like, are we going to see a lot of acquisitions, or is it going to kind of wait and see?
I think purely based on what I am seeing, I'll speak only for myself, that we are going to see a lot of acquisitions, but it's not going to feel like a lot of acquisitions because the number of failures are going to outstrip the number of acquisitions by a large multiple. So it won't feel like there are a lot of acquisitions, but we're going to see a lot of acquisitions where you have someone who has a large balance sheet who looks at a particular space and goes, oh, my product in this space is mediocre, or I don't have these 4 features and capabilities, and it's going to take me too long to build them. Here's a team that's already built it, and I think it's going to be easy to integrate, and I know I can get it on the cheap because they're not going to raise at a huge valuation anymore, an up round. And I didn't want to spend the money on it last year or the year before because it was too expensive, but that same exact thing right now is super affordable, so I will make that acquisition. while the market is bad and stays bad. And I will be strategic about it, and I'll go through and fill out chunks of my portfolio where I'm having a hard time building those things, where I would just like to move faster. And we're going to see a lot of that. We've already started to see it. We're going to see a lot of it.
Yeah, makes perfect sense. Well, let's move on to like a macro level, and but at the same time interesting to Aneel. What's interesting to Aneel? We asked you this question last year. What's interesting to Aneel in 2023? Like, what are you researching? Where are you spending your time? What are you looking into?
Yeah, it's a good question. I don't actually remember what I said last year. I should have gone back.
I didn't either. We should have gone back and said what you were.
Well, actually, I remember one thing I said last year, which was I very reticently said, let's talk about blockchains. And my contention last year was, even though I am skeptical of the whole space, I am not skeptical of the demand for things that people are doing with blockchains, like cross-border payments. So and I still think that's true. I think that demand has not gone away, because that demand was unlocked. And last year I said, I don't know that doing some blockchain or crypto thing is the right way to solve those problems, but when you've got a hammer, everything's a nail. But that demand still exists, and it's not going away. And the handful of places where Web3 is useful are persisting and will persist. And a handful of places where you can get the same thing done a different way, people are going to find different ways to do those things. And it would be an interesting exercise to parse those out and go see who's trying to solve a payments problem that looked like it had to be solved on a blockchain, but can be solved a different way. Because those are probably billion-dollar businesses. That's one thing. Another thing is this. I'm super annoyed by generative AI, not because it's not powerful. It's extremely powerful, but because I want simpler problems to be solved. Like I just want autocorrect that's better. And the same people who are doing generative AI could actually give me autocorrect that's better, but they're not going to do it. Instead, what they're going to do is give me a thing that does all the writing for me so that I don't need to be autocorrected. That doesn't solve the actual problem I have. It solves a different problem for a different kind of person.
There's no money in duck off. There's no money in fixing duck off.
but I mean, there could be.
Yeah, no, you're right. It is potentially a big thing, but you're right. There are millions of little things under the covers.
Yeah, I am super interested in how generative AI changes our thinking about how we do things, right? One of the things that bothers me about generative AI is that instead of solving underlying social or economic problems, like we can't seem to figure out how to educate enough people on Earth to build software. So we're going to make tools so that we don't have to teach people how to program things, that just do most of the programming for you. And that's true across any number of domains, where instead of solving the underlying problem, we're just doing this, right? We're like actually decreasing the need for humans to do specific things. On the flip side, the impacts are kind of fascinating. Like, maybe search becomes dramatically less important if, instead of searching for something, you talk to a bot that tells you the answer, right? And for a long time, search has sort of been moving in this direction. But if I don't have to search for a thing and I just talk to a bot that gives me the answer, where's the ad revenue going to come from?
Yeah, well, it also sort of feels a little bit like what we've seen with other manufacturing things. Do we hollow out a good chunk of the software development industry because we basically go, oh, we don't have to teach those people those things anymore.
Yeah,
over long periods of time.
Yeah, and there are all kinds of
other ramifications
scenarios around this. None of which we know anything about. But so all of this is me complaining in a way to say that I think generative AI is super interesting. It's going to have a lot of use cases that we haven't even imagined yet, and it will transform more than one domain that we operate in.
Yeah, I want to ask you a question. You've been doing this full time for a year. You were doing investing, somewhat previously, but you've been an engineer. You've been a product person. As you get more into the business, how much do you have a desire to be, to kind of help guide your companies? Do you, how do you give them feedback? Do they want feedback? Like what's the relationship that you have with your companies, and like,
Sure.
how much are you like, oh, I'd like to kind of scratch an old itch and be involved with some things?
100% of the time I'm like that, and 100% of the time it would be the wrong thing for me to do, so I don't do it, because that's not my job. Also, the founders are the bosses of their companies, not me. I'm not even the boss of the founders. I'm just someone who gave them some money and try to help as best I can whenever I can. This does lead me to answer a question earlier that I sort of ignored from Aaron. So what makes Crane interesting or distinct is that we're highly specialized. We only invest in a handful of spaces. So things that we think of as like I said, that can become critical infrastructure for building software, and like sometimes we'll do stuff in payments infrastructure, supply chain infrastructure, and that's about it. So we do a lot of open source stuff, a lot of developer infrastructure, machine learning platforms, data products, that kind of thing. And we don't do anything else. And we invest at the super early stages, pre-seed and seed. We don't do like A rounds or stuff like that. So we are highly inclined to help as much as humanly possible at everything. And we do. Because I have a background in product and marketing and engineering, I tend to help with all of these things, especially, as companies are trying to solve a complicated or thorny problem, or they're trying to figure out what their ICP is, their ideal customer profile, or they're trying to figure out what their funnel should look like, or they're trying to figure out a marketing strategy. And a lot of it is just, it's a combination of how much help they want from us, because we will go super deep sometimes, because this is what we do. This is how we help, and other times they don't need us and or want us, and it's like, it's not my job to force myself into what a founder is trying to do. It's just my job to help. So it's different situation to situation. Sometimes it's like very deep, where I'm in a constant text back and forth with the founder as they're going through dealing with an enterprise sale, because they haven't done it before. And so I'm helping them figure out how that works and navigate the waters of a complex 6-month sales cycle. And other times it's stuff that, someone said such and such in a contract negotiation. How would you respond to that? I'm like, well, I would either say A, B, or C, and then that's it. And they go off and do their thing. But yeah, it totally varies from company to company.
Good stuff. Well, Aaron, I think we may want to wrap it up there. We could probably go into a whole lot of things with Aneel. Aneel, one last thing. If anybody's coming by New York City, you are a notoriously well-diversed foodie. Lots of tastes and different things. But if somebody's coming into the city, into Brooklyn, anywhere, what are a couple of places that are on your top of the list of either places where you'll take friends, or just new places that you've heard are great?
Oh man, I could go on for days and days.
A whole other podcast.
Days, a whole other podcast right now. I will give 2 shout outs to my favorite neighborhood places right now. How about that?
Great.
So I live in a neighborhood called the Navy Yard, which is adjacent to another neighborhood called Fort Greene. My 2 favorite places right now is a place called Larina, Larina, which is an Italian joint that makes their own fresh pasta in-house, and their pasta is excellent. And my other favorite place right now is a wine bar called Rhodora, Rhodora, which is just very pleasant. It's all of the fantastic parts of like a wine bar, minus all of the pretension of, like a wine bar.
Nice.
That's perfect. That is perfect.
Well, good stuff. Well, listen, Aneel, as always, great to catch up with you. We need to do this more frequently, hopefully somewhere live somehow.
Oh yeah, that would be awesome.
And happy holidays to you. Happy holidays to you and your family and folks. Aaron, you want to wrap it up and take us home?
Yeah, absolutely. So first of all, Aneel, thank you so much for your time. This is fantastic.
Of course, thank you both for having me. Absolutely.
And for everyone out there listening, thank you again for listening and helping us continue to grow the show and reach more folks. If you enjoy the show, please tell a friend. Please leave a review. If where you get your podcast, you're allowed to leave some kind of review. And for that, on behalf of Brian and myself, thanks for listening this week, and we will talk to everyone next week.
Thank you for listening to The Cloudcast. Please visit thecloudcast.net to find more shows, show notes, videos, and everything social media.